It's time for the Money Puzzle Podcast with good conversations and realistic solutions to the money puzzles we all face every day. I'm your host, financial advisor, chartered financial consultant, and president of Edgen Insurance and Financial, Robert Edgen. Now let's get this show started. Hi there, hello, and welcome to the Money Puzzle Podcast. I am Robert Edgen, and I'll be your guide for the ride for the next few minutes. Each week, we look at a different piece of the money puzzle and practical ways to solve it, so you can have the financial confidence you deserve and the
future that you dream of.
That's right, the future that you dream of. Welcome to the studio, Mr. Brian Johnson, my business buddy from another mummy. Great to have you with me today.
Oh, it is almost Halloween.
It is. It's almost Halloween. This is episode number 31, and today we're talking about credit and what's credit got to do with it. Pretty much everything today is connected to credit.
Yeah.
Getting a job.
Right.
Renting a house.
Right.
Your mortgage payment if you're buying a house. Your insurance prices. Yep. Your ability to get insurance. Your ability to adopt puppies.
Well, not necessarily to get it, but yes.
Yeah, it could.
Possibly.
Yep.
Yeah.
Adopting puppies, that's tied to. And I also heard that Taco Bell is now checking credit before letting you order that new cheesy gordita crunch.
I don't know.
Those last two might be questionable, but the bottom line
Taco
is...
Bell, puppies, hey.
You never know. Listen, credit has to do with everything today, and here to help with that conversation, you're going to be here. We're going to talk through credit.
We may not agree totally, but we're going to talk through it.
So, but before we get to today's hot topic, I do a lot of reading and research, and I come across different financial news headlines that catch my eye. So I thought we would take a minute to look at some news. All right, today's news headline comes from Reuters, and the headline reads, "Thieves steal $5 million gold toilet from Britain's Blenheim Palace." It says the burglars have stolen a fully functional 18-karat gold toilet from Britain's Blenheim Palace, where it had been installed as an art exhibit just 2 days before it was stolen.
Art? I don't understand.
Well, it gets crazier. Listen to this. It was previously on display in a cubicle at New York's Guggenheim Museum, where more than 100,000 visitors actually used the $5 million toilet.
Were they observed?
I'm not sure.
Did they have like 3 security guards standing there watching them?
I mean,
to make sure they weren't chipping a piece off?
$5 million toilet. Not only was it stolen, but it says due to the toilet actually being plumbed into the building, it has caused significant damage and flooding. Here's my question, Brian. If you visited the Guggenheim while this toilet was on display, would you use the facilities on a $5 million toilet?
Why not? I mean,
I definitely would.
Yeah.
I mean, even if I didn't have to use the facilities, I would just pretend to use the facilities.
You would at least spit in it.
I would maybe have a seat.
No.
I mean, I don't know. Listen,
dude, it's crazy.
It's crazy. It's an expensive toilet, but
art. That's the. I don't know.
I don't know either. All I know is that it's not been recovered. And my guess is
why would it be recovered? You just melted down.
That's right.
Right.
Crazy. If you want to read the rest of that story, I've got the link in the notes below this episode. So go and check it out. But for now, let's go ahead and get to today's hot topic. All right, let's talk credit. Now, this topic came up for me because I just finished reading "I Will Teach You to Be Rich" by Ramit Sethi. He's written a couple of different books, and there's a little section in there on the importance of keeping a good credit score, which I certainly believe in. And then I was thinking, I should talk about this. And I got an email from one of my lenders that I work with a bunch of how negative things impact your credit. So it moved credit high enough up the ladder in my life for us to sit here and have a show about it. But I don't want this to be some scary episode where we just tell everybody, cut up your credit cards, pay cash for everything. Credit cards can be, they're stupid tax. I don't want to be that kind of episode because credit, if you use it wisely, can really elevate your wealth.
Okay.
You disagree with that?
To a certain extent, I absolutely do.
I think credit can provide leverage, and leverage can help accelerate your wealth. Okay, so to me, credit is very important. It's enabled me to buy multiple rental properties and to expand my business.
Right.
So I think that if you're smart about your credit and you don't use it foolishly, it can be great. However, it's easy to be foolish with credit.
Always a however in life.
All right, so let's talk about what impacts your credit score. And this is coming straight from Ramit's book, I Will Teach You to Be Rich.
Yeah, and it's online too. I saw a video of this last week, a 30, 40-second one.
So yeah, it's great. So, but basically how your credit score breaks down is 35% is, or what makes up your credit score, I should say. 35% is your payment history, how reliable you are at making your payments on time. 30% is the amount you owe to credit versus the amount that is available. That's called your credit utilization rate. 15% is your length of history, how long you've had credit going. 10% is new credit and the comparison to old credit. How much of it is new versus old. And then 10% is the types of credit that you have. Okay. Credit cards versus car loans versus student loans, so on and so forth. Okay. So that's what makes up your credit score. But I want to talk about things that are impacted by your credit score and why credit would matter for each one of those particular things. Okay. So let's start with car loans and mortgages, because these are big purchases. And almost all big purchases are made with credit. Would you agree with that?
Yes, I hate car loans. Hate it. Hate car loans.
See,
I would say never do it. I hate them.
And I'm on the other side of the fence.
I know. The problem that you run into, even if you put down a payment, a down payment on the car loan, is that upside down flip. You crash that car, somebody else crashes it, you're not getting anything out of it. That money that you put down is gone.
Well, gap insurance helps, but that could be a conversation for another time. But I see what you're saying. I get what you were saying. And if everyone had cash to go buy a $20,000, $30,000, $40,000 car.
Right, but you don't need a $30,000 or $40,000 car because there's a lot of things online. If you look at the top 20 cars that depreciate like mad in the first 3 years, great example. I had a 2010 Audi that blew up on the stinking highway, right?
Yeah.
I paid $26,000. I paid for it in cash. It was done, and it blew up on the highway. Point is, there was another one, a 2010. I just looked at it. It's 9 years old. It looks just like the models that you see on the road today. It has 63,000 miles on it. And what they want for it? $9,000. $9,000.
All right, you can pay cash, but listen, most big purchases are paid for with credit. Okay, whether you like it or not.
A house, real estate. I get it.
Well, this is my problem with like what I hear some financial gurus say. And if you are listening and not watching, I've got gurus in fake italics over here. Yeah, fake parentheses. What are these? Fake quotation marks. Yeah, fake quotation marks. But here's something that I hear some very popular gurus say. Never buy a car on credit. That's stupid. Right? I hear them say that. What you should do is take, go buy a jalopy for $2,000 and then put $400 away into your investment account for 2 years. Then you'll have $10,000. Plus your jalopy's worth $1,000.
I've heard that too, and it is extreme. Yes, because I don't agree with that. That side of it, I don't agree with either. But your income is your most powerful wealth building tool.
I agree with that.
If you're spending it on a car that depreciates, what Warren Buffett always say about cars, you never invest in a depreciating asset.
Listen, I get what you were saying. That means you should start walking for starters.
No, I pay cash.
You pay cash. Well, that thing's still depreciated.
It does, but well, guess what?
If you try to do it without credit, this is what most people do. Okay, if you want to follow the financial gurus, pay $400 a month for 2 years, move up to a $10,000 car. Pay $400 a month into an investment account, $20,000. $400 a month, a $30,000.
Right.
If you just looked and you financed a car for those same 6 years, you could do it for the same $400 a month, but you weren't driving a piece of crap car for 2 years, and then a lesser piece of crap for 2, and then a decent car for 2.
Yep. No, that's a great point.
So here's the deal, though. If you're going to finance, which most big purchases are financed, if you keep your credit good, it can make the difference of tens of thousands of dollars in what you pay, especially on something as big as a mortgage.
Yep.
You know, I ran the numbers for a 60-month auto loan, and good credit versus bad credit was about a $4,400 difference.
Yeah, that's
which is big.
It is. It is big when you think of it. It's $400. Well,
but on a house, a $200,000 house for 30 years with decent credit, maybe you pay $355,000 in total payments over 30 years for a $200,000 house, which is still crazy. It's $155,000 extra for that house. But if you have bad credit, you're going to pay about $425,000 in extra $70,000 because you have a lower credit score.
Right.
You know, so it matters, especially for those big purchases, because those big purchase banks or lenders want to know, is this person responsible enough to make the payments so I don't have to foreclose on the house or repossess the car?
That is part of it. That is true. They also want to know, can I get them more money?
Oh, totally.
So therefore, you're more in debt.
So they can charge you more interest.
They do.
That's right.
Absolutely.
The banks love people with less than great credit. Why? Because they get to make an extra $70,000 on a house purchase.
Well, it's not just less than great credit, but even if you have great credit, oh, well, wait a minute. You only want a $400,000 house? You qualify for a $550,000 house. They try to push you that way, true.
They do. That's a whole different conversation. Yes. Should you always take the max credit? But that's yes. But for today, does credit matter? For big purchases, obviously does. But you know what? Here's why else credit matters. What if you're trying to rent an apartment?
You don't need credit to rent an apartment.
Oh, yeah, you do.
Oh, no, you don't.
Maybe not a apartment, but
for this landlord,
maybe a decent apartment. You know, listen, as a landlord, and
typically what happens when you rent an apartment, if you don't have credit, your security deposit is more.
Okay, so that costs you more out of pocket.
You have to put, well, to a certain extent, you'll get it back
Maybe.
if you're a good renter, right? If you're responsible, if you're paying with cash, you're responsible, and you typically will have to put up a couple more months up front.
So more money out of pocket, and I know plenty of apartments and landlords who, if they've got 4 tenants who are lined up right in front of them, and they all have the same, qualifications, but 2 of them have great credit and 2 of them have really poor credit that show that they're not responsible at paying their bills.
You're talking poor versus none.
So now I'm talking about poor.
I know, poor versus...
So
I know. The poor people are going to get it. But if I had no credit to go in an apartment and you have really bad credit, I'm getting the apartment.
That's probably true. So again, does credit matter for renting an apartment? Absolutely. Yeah. It'll keep you from paying less out of pocket, and it'll get you into maybe a better place. What about getting a job? Does credit matter?
Some do. Some places require a credit check. That's right.
It's same thing. If an employer has 4 options where they've got the same education, the same backgrounds, the same history, but one of them has great credit and one of them has shown to be that they're less than responsible on their credit,
right?
Could that relate?
A bankruptcy or something? Yes.
Could that relate to a job?
It could. It could. And some of that makes sense. Yeah, because I wouldn't want to hire somebody in my office. Or hire somebody maybe in your office, I wouldn't mind. But in my office, I don't want somebody who's had a bankruptcy.
Well, I mean, a financial office.
Yeah.
There are restrictions when we hire. Yep. We don't do credit checks, but the home office might.
The broker-dealer does, absolutely.
Right. That's right. They have to make sure that the person you're hiring is a responsible enough party because they're going to be dealing with financial matters.
Right, when they're dealing with financial matters, what if they liquidated a client's account?
So yeah,
it can be really risky for us.
So getting a job, yes, it matters for that. How about your auto and your home insurance? Does credit matter?
It does.
Absolutely, but not for the reason that most people.
Right.
I hear people say all the time because we both also own insurance practices and financial practices. I hear people on the insurance side say, "Wait a second, what does my credit have to do with it? I'm going to pay my insurance bills. I've always paid my insurance bills." The insurance companies, yes, they care about you paying for your bill, but you pay for insurance in advance.
Yep.
So if you don't pay your bill, you just don't have insurance. Really, why do they care about your credit for insurance?
It's a rating system for the likelihood of having a claim.
That's right. Insurance companies care about, is this person going to cost me money? And when are they going to cost me money?
Right.
It's all driven by actuaries and statistics. And statistically speaking,
it shows that if you have bad credit, you're going to
file claims faster.
That's right. Absolutely.
That's right. Insurance companies want to know, when's this person going to cost me money? And the biggest statistic driving that right now, that decision, is their credit score.
It is a major factor.
Yeah. Now, most insurance companies don't use an actual credit. They use a modified version called an insurance financial score.
I don't know. I don't know all of them, so I don't know what the percentage is. But it's called an insurance risk score.
An insurance risk score. Yeah. So it makes a huge difference on your auto and your home insurance prices. What about your life insurance? Does it matter there?
For a rating, as far as being preferred plus or preferred standard, if you have bad credit, you're going to get a standard rate. It doesn't matter how healthy you are. You're going to get a standard rate.
That's right. It's life insurance is no longer just about how long is this person going to live? What's their health? What's their family health history?
The reason for that, the insurance company has to have so many assets on the books in order to be able to pay claims, to be financially sound, and all the ratings that you hear. And if you apply for a whole life policy, but your credit is terrible, the chances of you lapsing that policy go up. So therefore, they charge you more.
That's one reason. Another reason, new statistics show that people with the lower their credit score, the faster a death claim is filed.
Oh, so really? I did not know that.
Right. This is kind of crazy thinking, just to think that insurance companies pay more death claims on people with lower scores.
I did not know that.
I know. I think it's nuts. I mean, I don't know if I necessarily agree with all of these things. They just are what they are, so we're talking about them. Well, how do negative things impact my credit? What's really happened? So just a list of what I found.
Yeah.
And this was from my lender.
Okay.
A late payment will drop your credit by 110 points.
Okay.
It's pretty big.
Is that 30 days or what is considered a late?
It just says a late payment. And this is the other thing that it said. It doesn't matter if it's $1 or $1,000. So $1 late versus $1,000, it impacts you the same.
Oh, so if you, like I pay online with things, so if I owed $1,000, I don't know, $1,001, and all I put is
$1,000, then
it'd be considered late. So for a house payment, not a credit card, but a house payment.
But a late payment, the size of the payment doesn't matter. Just the fact that you missed it does. It's 110 points. Okay. If you go through a debt settlement program, it's 125 points off of your credit. A foreclosure costs you 160 points. A bankruptcy is 240 points. I mean, that could take you from a 750 to a 500 just like that.
That makes total sense. I get that.
Collections is 110 points. And then get this, just a hard inquiry. So you want to go get a loan. Let's say you go to 4 different car dealerships because you want to try 4 different cars, and all 4 want to see what rate they can give you, for your payment. Right. Now you have 4 hard inquiries. Each one is worth 15 points. That drops your score by 60 points. Because of all this credit stuff, I have clients say to me, sometimes, maybe I should just ditch my credit cards. Maybe I should cut them all up. Maybe I should just not use them. Brian, what is your thoughts on should you have credit cards?
So I'm not a big fan. I have one. I use it once in a while. We very rarely have big credit card bills, if any. I like doing cash because cash is one of those things that's hard to get rid of. Right. I mean, a great example, David, my son, wanted a water bottle, but he wanted me to buy it. And I said, you have money, you buy it. He goes, that makes I'm not buying it with my own money. I don't, he said, that hurts. No, I'm not doing it. So yes and no. But if you're responsible, you can use a credit card. If you're not responsible and you're running up debt, so if you cannot pay that thing off, you need to get rid of that card.
All right, so I'll give you my opinion on credit cards. First, even if you have great credit, you still have crappy interest rates on your credert cards.
You do if you don't pay it off. That's right.
Yep. Yeah, if you don't pay it off. Yeah, even the best credit cards have crappy interest rates.
Well, yeah, one of the things that I found out, because I mistyped, like we talked about earlier, on my credit card payment, I put, it was just like $10 short from the full payoff. They charged me interest on the entire amount. I thought that, by the way, and they removed it. But in interest on the entire amount due.
So 30% of your credit score is based on the amount or on the amount of available credit you have versus how much you've used. To me, it's okay if you have credit cards, right? You need them for a rental car. You might be able to take advantage of miles, which is what I use mine for because I travel a lot more than you do.
I know you do, but how much money do you have to spend to get a free plane ticket?
I just got 2 free plane tickets.
How much do you have to spend?
Anyway,
that's a whole other
It's money that I was going to spend regardless.
Maybe.
But as long as you pay it off each month.
But here's the thing. The studies show that people that use credit cards to buy stuff will spend 20 to 25% more than they otherwise would by using a credit card.
That could be. This is my advice that I give to my kids and also to my clients. If you're going to use credit, never go over 50% of your credit limit because then it affects your utilization rate.
It does, and yeah.
No, it does.
I know it does. But if you get to that point, you need to cut it up because that means you have a spending problem and now a debt problem.
That is not true. You know how many business owners use credit cards and pay them off every single month and then fly for free? And I just watched a commercial with the farm girl flowers who got $115,000 cash back last year.
How much did she spend to get that cash back?
Probably $1,150,000.
It's horrendous.
But you know what? She was going to spend that money anyways. If you were responsible
she probably
with
spent 30% more than she otherwise would just to get a little bit back. It's not a good deal.
A lot of assumptions.
It is not a good deal.
If you're going to use credit, which I use credit every single month. Okay, and I pay it off every single month. But what I tell my kids is, number one, and my clients, and myself, never go over that 50% limit because it's going to hurt your utilization rate. Number two, pay it off every month. If you cannot, never ever buy anything that you can't pay off in 2 to 3 months. Okay, that's what I tell my kids, because sometimes, Brian, life happens, and not everyone has that $50,000 sitting in their wallet just to go buy water bottles.
Right, but what we teach people,
okay,
is to be responsible with your money, and that includes money in your savings account. So life should not happen.
What I teach people, and we do, is all of those things. But you know what? Also, you don't have to, live like a pauper today to live like a king tomorrow. You can, if you are balanced, then you can have some control, which is really what we teach. How to be good with your money.
Right.
Being good with your money, dude. I fly for free all the time, and you know what I do? I pay off my credit cards at the end of each month.
Yep.
So. We obviously we could probably talk about this forever. So
we don't agree
all right.
on this.
So we talked about all of the things that impact your credit, how it matters. What should you do to make sure that your credit isn't impacting you negatively? First things first, you need to go check your credit.
Yes, I pull mine every year.
So absolutely, I do as well, from annualcreditreport.com. That's the federal one, and it's absolutely free. You can also do like Credit Karma and MyFICO.
Yeah, the free one's the best because you have the right every single year from all 3 credit bureaus to get a copy of your report.
So absolutely, an annual credit report. Yep. I actually just went in and I was checking mine, and I found this old card that I had completely forgotten about from 2000.
Wow.
I mean, it hadn't been used in, like 18 years, but I had forgotten about this old, and it was at a retail store. So, retail credit cards impact your credit more in a more negative fashion.
Do. Absolutely.
So I went and I canceled out. But you have to know what's on your credit report. So you need to go check it. Second, if there are errors on that credit report, you need to dispute them.
Yep.
Right? Third, if you have old accounts that have not been used in a long time, especially if they are for retail stores, I think you should get rid of them.
Get rid of them because of the fraud that's been taking place out there is huge.
So the fraud. Well, plus look at insurance scores as an example.
Yeah.
Retail cards have a big impact on insurance financial scores or insurance risk scores, and a lot of times people are like, "Oh yeah, I'm at Macy's. I'm going to spend $100. You're going to give me 10% off if I open up a card? Awesome." So they mistakenly take a $10 discount, and then they pay $40 a month, hypothetically, extra on their insurance prices because it drives their prices.
Hypothetically, because we don't really know.
We don't really know. But the bottom line is they pay more.
They do.
I think we
exhausted it.
I think we beat this.
We can argue next time.
We're probably going to argue as soon as we turn this camera off, but that is it for today's episode. If you got some value out of it, do us a favor, share it with a friend who needs to hear it. Make sure that you give us a rating on whatever podcast app you're listening to this on. Like us on YouTube if you're watching us. Make sure that you share us with a friend and subscribe so you don't miss any shows.
And the little bell.
So if you've got any of your own questions about your money puzzle, email them to questions@yourmoneypuzzle.com. But that's it for this week. So until next week, be safe, have some fun, and do something to help solve your future money puzzle. Your future self will be glad you did.
Have a great weekend.
See ya.
Registered representative of and securities offered through Securities Management and Research Inc., SM&R. Member FINRA SIPC. Investment advisory services offered through BFC Planning Inc. Edgen Insurance and Financial Services, Johnson Financial Services, SM&R, American National Family of Companies, and BFC Planning are independent entities. There are risks involved with investing which may include market fluctuation and possible loss of principal value. Particular investments may not be suitable for certain situations. Carefully consider the risks and possible consequences involved prior to making an investment decision. Our firm does not provide legal or tax advice. Be sure to consult with your own legal and tax advisors before taking any action that may have tax implications.